EasyJet's board called Castlelake's approach highly opportunistic, and that word choice matters more than the defensive posture it signals. The American private credit firm, which already holds a 2.14% stake in the Luton-based airline, announced on Friday evening that it is considering an offer at no less than 403.23 pence per share, valuing the carrier at a minimum of £3.6 billion. EasyJet shares had already lost nearly a quarter of their value over the prior 12 months, pressured by the Iran war's impact on jet fuel prices and forward booking rates. Only 40% of summer quarter seats were sold at the time of the company's May update, 3 percentage points below the prior year. Castlelake is not making a bet that the war ends. It is making a bet that 403 pence already prices in a worse case that the market will eventually revise upward. The board's counterpoint is structural. Regulatory and ownership rules governing EU operating licenses mean a US-controlled entity cannot hold majority voting rights in an airline serving EU routes, and JP Morgan's analysts flagged that Castlelake would need either a minority structure or a European partner to preserve EasyJet's intra-EU rights. Foreign institutional capital interpreted the bid as a price floor signal, not a done deal. EasyJet shares rose more than 10% in Monday morning trading in London, while IAG added 6.5%, suggesting the sector rather than the single name absorbed the confidence signal. The capital flow traceable here is foreign private credit identifying a geopolitical discount entry. The open question is whether the regulatory architecture forces a restructured offer that dilutes the premium, or whether Castlelake walks away and leaves the price floor exposed.
The mechanism that makes EasyJet's situation legible, a geopolitical shock producing an asset discount that foreign capital tries to capture, looks very different when the shock is regulatory rather than macroeconomic. Wise, the London-listed fintech processing more than $243 billion in cross-border transactions annually, saw its shares fall nearly 15% on Monday after Belgian prosecutors confirmed their investigation into suspected money laundering through Wise Europe is now at an advanced stage and nearing its conclusion. The Brussels Prosecutor's Office, which handles all EU-wide enforcement requests through Belgium because Wise Europe is headquartered there, said findings primarily concern the use of Wise accounts for criminal purposes, with suspected links to fraud, corruption, and drug trafficking across 30 European countries. Wise disclosed that it holds over 80 regulatory licenses globally, and around a third of staff is dedicated to financial crime controls, but the market did not price institutional reassurance on Monday. What it priced was position exit by holders who had previously treated Wise's compliance infrastructure as a competitive moat. That moat framing is exactly what the investigation undermines. If the Belgian finding confirms material AML control failures, Wise's licensing position across the EU becomes the liability, not the asset. The structural difference from EasyJet's situation is that foreign private credit cannot take a long position on regulatory resolution the way it can on geopolitical resolution. The timeline and outcome of a criminal investigation are not mean reverting. Retail and short-duration institutional holders exited on price action alone. Longer-duration holders face a different calculation, because no specific findings have yet been formally shared with the company, and the next observation point is the Belgian prosecutor's formal conclusion. What that conclusion does to Wise's EU operating license, which covers the entire continent via passporting, is the variable the price cannot yet settle. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.